Hello, this is Sergio Marrero, and we are here with RBL1 Live. And we have a special guest tonight, Chinedu Enekwe, who is the managing founding partner of Aux21 Capital. Thank you for joining us tonight, Chinedu.
Thank you, sir.
Absolutely. So Chinedu also, he's a lawyer, graduate of Howard University School of Law. He has also managing partner at Affinity VC. He is the co-host and producer at Venture to the World. He's been we've crossed paths several times, so been a hustler in this space and excited to talk about his new fund, Aux21. So I'll turn it over to you to share with the audience. What is Aux21?
All right, thank you. I appreciate actually being here. It's great. I love what you built with RBL1. It's great. I look forward to always who you have on. I'm glad that I'm on it today. So Aux21 is a seed stage venture capital firm investing in the future of retail and the future of finance for the next generation of internet users, right? So that's the tagline. The sort of subtitle to that is we look at opportunities that tap into the global pulse of human connection, meaning we think that people are centered around commerce and connection through communication. And there's technologies that surround all of those things that push that ball forward and make us more connected, right? So whether we go from the telephone to real-time gross transfers, in any way that the paradigm is to go quicker, faster, and to be more connected. And the technologies that enable that across countries, across people, across cultures are what we plan to invest in. And I guess, if you want to get into details, we are we're raising our funds. So we're pushing towards our first close, and our target size of the fund is 75 million with 100 million hard cap, and we're actively pressing toward the first close towards the end of this year as a dream, right? But we're close. But you never know until the papers are signed.
That's it. That's great. It's you need more. We need more of of us out there starting these funds, raising it. And I'm glad you're here to share your story. What size checks are you looking to write? And just so founders know, at what stage are you looking for, so they know when to come to you.
Okay, that's perfect. I think what I would say is we want to build a relationship very early with the founder. So whether it's seed stage, so we're investing at the seed stage, but what that means for us, there's different rounds of funding, different names. So what we're trying to do is be true to what we think drives the most value to the founders, our investors, and ourselves. So what that means for us is we're looking at valuation more over an ownership stake. So if a startup is closer to the $10 million valuation towards the $30 million or $40 million valuation, those are the times where we'll make an investment, because the pricing, it will allow us to own or obtain 10% ownership of a company. So when we say check size, it's going to be reflective of the ownership stake that we can get. Sorry. So we're looking to obtain 10%, 10 to 15% of a company, and we'll lead around. So that means check sizes, when we look at it, from 1.5 to about $3 million thereabout.
Got it. And can you share, can you share with the audience? I know we've spoken. You've been all around venture in different ways, and you started your educational training more as a lawyer. You've been principal at different venture labs. How did you go from being a lawyer to now starting your own fund?
So that's very simple and easy, but it's long-winded. So I'll make it very short. So there's periods, right? So I was in law school. I got an introduction. Well, I had a law firm interview with a managing partner of a firm, which is a large New York-based firm. And the partner said to me, he was introducing, I was 21, he introduced me to what was private equity. And I had come out of engineering in undergrad, and I had no idea about business, like different types of private equity. That was so far away from my thinking. I had no idea what it was, right? No one in my life was like an investor in that sense. And so in that interview, I was introduced to alternative capital, and I was like, wow, I wish I can be a part of that. And I thought at the time I could be a lawyer to help. And then the first day that I was working with the firm, I got the offer. The first day I was working with the firm, they put me on a transaction where there was it was for this firm called Global Infrastructure Partners, right? And the founder of that firm, the lead GP, was a Nigerian guy, right? And he was getting Credit Suisse and GE Ventures to contribute, or GE Capital, sorry, to contribute $30 billion to his fund. Now, I didn't know what I was looking at. I was 22 at this time when I was set to the office. I said, I don't know what I'm looking at here, but this tells me that the glass ceiling doesn't really exist if you can make it not exist. Not to say that it's easy to get any of that type of capital. He obviously worked hard to establish a track record of trust with both institutions. But I saw it, and it was the first thing I ever worked on professionally, like, post school. And I said, wow, this is possible. So then I thought to myself, I want to be on the other side of the table. So I tried to get into finance, and after that, I went to work for Merrill Lynch, and I transitioned from there, from investment banking into, while I was an investment banker, I did a startup, and I was able to actually sell the startup. And then I started doing venture stuff. And one of the things I learned from investment banking, and on that side of the table of investment banking, advising and founders basically to raise capital, but for large scale infrastructure projects all around the world, I realized that I loved to be an advisor to entrepreneurs when they were largely thinking and dreaming up ideas, right? And when I was able to launch my own company and sell it eventually over 2 years, I realized that maybe there was a lot of entrepreneurs that were like me, trying to build technology-driven opportunities where I could probably build a fund, like a venture capital fund or an accelerator, and invest in them. And so that's how I got into launching an accelerator called Tip Hub Africa, and then building my track record from there. I was able to launch or take, basically in venture, it's best what you can do for free. If you do many things for free, some things will come back to you positively. I didn't set out to do that. I was earnestly just going out and doing things and being helpful and volunteering and supporting anybody that's working in the early stage startup. But what I didn't recognize that I, subsequently got to know is that earnest kind of desire to help someone at the ideation or formation stages of their business. People start to recognize that and notice it, and people will try to give you opportunities so that you can invest if you're lucky. It doesn't happen with everybody. And sometimes you don't have enough capital to bridge the time between your earnest desires and when you have to make your ideals meet up with the bills. But I had those opportunities and I used them. And that's how I got into venture properly, working as a principal at Exponential Creativity Ventures. And that's at the same time I launched Affinity VC, which was basically a very bold, and it still is a very bold, ambitious effort to make sure we rebalance the levers of capital, basically. And we did that through many ways. So one, we had a syndicate investing in early stage startups. Two, we had an advisory practice advising the early stage investing of corporations and foundations. And then three, we had a fund of funds, basically, that was seeded by a family office that we advised as well, that we were placing capital into diverse emerging venture fund managers. So, it was very ambitious, and it still is. Took a lot out of me to kind of build a community and to do all of those things. But that ambition to do those things that weren't necessarily rewarded capital wise helped me build a lot of relationships that's, very additive to this moment as we're raising capital for Aux21.
No, that's great. I appreciate you sharing that. I'm sure the audience does as well. And can you talk a little bit about how you moved it? I know there are several aspiring fund managers in the audience, so can you share with them what are the things that you did to move you from to now I have an idea to I actually have at least soft commitments from this community. What were some of the things that helped you be successful in making that initial step toward your close?
Okay, so I think what really helped was two things, right? I have a partner, and his name's Mark Fleming, right? So he left Alibaba, and he and I, before he was leaving Alibaba, he was one of the people that I wanted to convince to launch their own fund, right? So I was talking to him, and we spoke through the investment thesis for a considerable long time. So it wasn't like we kind of thought of it on a napkin and put it together. We thought of what the thesis was as a nugget or a kernel, and we kept on developing it. So from that point, we kept on workshopping the concept and the idea. Fortunate for us, we were already in investing roles that establish our track record. And then from there, so a lot of our soft commitments come from the institutions that we had affiliations with, right? So affiliations or that relationships that we've had for, maybe 6-7 years. So that kind of provided, because we kept on workshopping the idea, because we kept on circulating that idea to those people as to what we were planning to do, that gave us a sort of head start. So when we actually decided that we were in the market, we were already sort of 2 years into socializing the idea with people that would commit it to us, or maybe a year and 18 months into socializing it. But it was easier conversation because we were already sort of socializing the conversation. And I think that's the biggest lesson that I've learned. Like, the idea of raising a venture fund is time based, right? Like, you have to have something else not paying your bills. Well, it's either your savings or another role or job. You have to have something so that you can explore all the avenues and nooks and crannies that are necessary to build a relationship that then can yield a potential investment.
I no, that insight is very clear. It takes time. They say 12 to 18 months. You talk about the relationships you built over time, which were way longer, right? Depending on, it may take 12 to 18 months for someone that's in the field, right? And then it may take longer for people that don't have those relationships. So,
I think,
oh, good.
yeah, I think one of the critical components though is like, but that just has to do with my own network, right? Like, if my network was a little bit more high net worth, a little bit more own their own capital and high net worth, it might have been a lot quicker, right? But my network isn't like that, right? And a lot of people that look like you and I's network doesn't kind of come in that variety, So, to be honest, a lot of it comes down to, someone that I begged to be on my board of directors as my accelerator now sits at the head of this other institution, and I'm going to call them, and then they're going to introduce me, and that helps, right? Like, it wasn't like I started out 2013. It's not 2013. This is 2020.
Yep.
So this is like 70 years of my life going. So, it's not as easy to, once you think you have the skill and you have the desire, you got to have some longevity in this space. And, I don't think that's 100% necessary. I know other people don't have it, but I'm happy that I do, because my perspective has been sort of shaped by that.
Got it. How did you come up with the name? Oh,
So
O21, which I incorrectly first said Aux21 because it looks like that's how I read it. But
don't,
yeah, if you could share a little bit about the origins.
no, don't worry about that. Like that, it's actually funny. There's like a multiple reasons why we named it that way, but I could give you the boilerplate one. So O or AU is the symbol for gold, and then X bar is the symbol for mean. So we are actually, I told you that we believe in the global human connection, and we think that there's probably technology that drives that forward, and underlying that is a formula of like that probably is this common thread amongst people, and one common thread amongst sort of multiple groups is this kind of golden mean, the arithmetic mean. The golden mean is basically this mathematical concept that beauty and a lot of reoccurring shapes are basically this math fall in line with this mathematical ratio. And so we went we overdid it and we did golden mean, and then 21 is theta, and theta is also another symbol for the golden mean. So it's like the golden mean, the golden mean. But
That's awesome.
that's pretty much it. So obviously we are not we may be considered geeks if we, so that's just basically what it is. That's the meaning. It's underlying global human connection. We think that this ratio and mathematics and technology are all connected across different spaces. So
Awesome. Love the focus on connectivity. Speaking of connectivity, can you share a little bit more about what you think, what you want O21's competitive advantage and uniqueness to be?
yeah, so we thought long and hard what that would be. It kind of stemmed from Mark, my partner's experience. He was working at Alibaba investing, and he created an investment thesis for them. Prior to that, they didn't have like a written down investment thesis. And so he created it. And part of what we sort of have taken from that is a lot of parts of their investment thesis is driven by what can be valuable to Alibaba. But it was based on this idea that there's a lot of local opportunities around the world for technology to drive commerce forward and financial technologies forward. And it just so happens that most of the world is sort of ahead of America in those two very interesting categories. So there's new technology opportunities that are going to be created in a group of people who are basically 40% of the world, or majority of the world is going to be in Southeast Asia, and then also Asia, China, India, and then also Africa. When you look at the growth kind of trajectory of for 2030, and those new internet users are going to leverage technologies that are largely not in America, right? So our thesis is largely driven by the opportunity that a lot of technology opportunities are going to slowly emerge in America, and startups will start to build things that fit into the omni-channel commerce lane, interactive AR media lane, mini apps for retail and logistics, third-party logistics. Many of those technologies will have a greater and larger home in the new generation of internet users, right? And to do that, our value add to founders is when you actually want to plan to go to those countries, you have to think of market entry, you have to think about navigating regulations, you have to think about building large scale partnerships and navigating those thorny issues, especially internationally. And when we looked across the field of different startup or venture capital firms, we said, this is a unique skill set that, many in Israeli VCs have, a lot of Series A investors in the UK or Europe have. But when you look at the US, there may be one or two firms that you might go to if you thought that you wanted to go abroad, that you wanted to go to China or India. You may go to one or two firms, and after that, you're sort of, you don't have too many people that you would look up in your Rolodex. And we are that. So we are that's our sort of special sauce. We are another another firm in that ilk, but our I think another special element about Mark and myself particularly is the blend of experience, mind that comes, we're both multi-stage investors in venture. Mark spent time in working at Calvert Special Equities, also investing in funds. He also, worked on the corporate venture side. I worked on the accelerator side. I was an operator, and then I also invested at the pre-seed level, and I also was an LP. So that sort of experience and relationships, in addition to our on-the-ground experience working and investing in Africa for me, Africa and Latin America for me, India, Southeast Asia, and China for him, we believe brings a lot of value to an entrepreneur that is looking to do market entry, navigate regulatory relationships, or build corporate partnerships, that a firm of our size and of our sort of fun position at seed, there's not many people that have that. So we think that's unique. And one of the other parts of it that we think is unique is that we're people of color. And that's not to say that there's anything that makes us better because we are people of color, but some founders want to have a diverse diverse LP, and they want the perspective of people that may have a different understanding of the consumers that they're going into, that they're planning to sell to, and that's what we're bringing to the table. So it's the diversity quotient actually adds some value add of understanding the markets that they may enter.
Great. And in launching the fund, I know you've seen quite a number of trends happening in the space. Can you share a few of the trends you're seeing in venture capital today that you think people should be aware of?
Okay. So it depends on the perspective that we're going after, but if it's from the fund manager perspective, I think there's a couple of them that I would say. So I would say from a diverse fund manager perspective, there's a lot of LP dollars that seem to be chasing very few fund managers right now because of the sort of the climate around race and inequity. There's a lot of dollars looking to place their capital into fund managers, but they are also hedging their bets by making sure that they're only evaluating fund managers to have sort of a first close already in the books. So, I mean, that's natural, though. People tend to gravitate towards things that have already become established. So those deals are happening. So I think that's one of the big things that I've noticed that is increasing and that there's more dollars chasing it. I think the second thing that I've noticed is that, there's new models or new investment vehicles or new branding around existing investment vehicles or new structures that make it, for instance, AngelList came out with rolling funds earlier this week or last week, for instance. And, what that is sort of just like a variation on an existing investment format. But I think it gives a lot of aspiring and emerging fund managers an ability to create a track record, which didn't exist before. It's not new. It's just kind of an innovative spin on two existing models that are blended together. And then the third trend, and you can double click on any of these trends and I can go deeper. But the third trend I would say is the alternative investment models that are keying into a venture. Because venture is traditionally like stage-based financing for growth to become, large brands and billion-dollar outcomes, right? And are targeting those billion-dollar outcomes. So that stage-based financing has kind of received many shakeups. There was Bitcoin and ICOs, and that was kind of short-lived. There are this emergence of like Zebra, sort of the Zebra movement, and these alternative financing mechanisms that is also targeting early-stage finance for people that are seeking venture scale returns as well. And I think that is, and there's been funding that has been deployed to back those different models which to me is the most, those are sort of the three most interesting trends around venture that are sort of just swimming at this point.
It, doubling down on, I know you mentioned ICOs, like first we had like the cryptocurrency ICOs, and then now I don't know if you've seen some of the effort by Republic has launched the notes,
Yeah.
that are, you know, digital representations of future profit, right? Like diversified future profit. What are your thoughts on that as the evolution of this digital asset movement? Like, do you think it has legs? Do you think it's another, you know, experiment? Well, you know, like what are your thoughts on where it's going to go? Because the market is pushing for faster speed, more liquidity, smaller investments, less friction, right?
Mm-hmm.
And costly. To reduce the friction, also reduce the cost. A lot of people don't understand is to even make a smaller investment. Why by smaller? It's like people can write individual checks of 5 to 100,000, and then even people that are writing smaller checks of, you know, you have crowdfunding and even syndications, like all of that, the cost of the legal fees and the just the administration prohibits smaller investments from just happening at a high speed, and that's, I feel, what the market is pushing for.
Mm-hmm.
What do you what do you see enabling that, or what, like I think people are going to keep trying to innovate in the space. But I know I said a number of things, but you know, just
So
your thoughts on first the crypto, not the crypto, but like the digital assets, would
I
be great.
think that's a really good point, and I kind of missed that trend. I didn't miss it, but it's part of a kind of ongoing sort of like crowdfunding was the first trend in like 2012 that then was eclipsed by ICOs. And crowdfunding has reached a level of maturity that demonstrates where it actually will land in my eyes, right? In terms of what segment of the venture capital space it will kind of occupy, right? And there's been some very significant crowdfunding wins, especially amongst people of color recently in a 9 or 7 figure range. I think you participated in one. One, congratulations on that. That's a great company. I met the founder like 2 years ago. He's a great guy. He was definitely pulling things together. So I think you guys pulled the trigger probably at the right time. But what I would say is that those elements are 100% of what needs to happen, especially for that asset category of crowdfunded startups that leverage, especially whether it's equity or any of the kind of Reg CF kind of metrics. I think that's 100% needed. I would love for the revolution around ICOs and crowdfunding to merge like it is on the Republic platform, and then the original dream of the size of the opportunity that crowdfund brought, meaning like retail investing for every mom and pop. But I feel like we've reached like kind of that Gartner edge of the curve where you're like, you know, we're in the point of disillusionment around crowdfunding and ICOs. So just in terms of market sentiment, which can change at any moment, right? You know, if there happens to be some outsized crazy return that comes from a crowdfunded company where people have that, like all of that can come together, right? Like the secondary market, all of these things, there's a lot of changes. You have Forge happening, you have Carta trying to launch their secondaries market as well. So I think we're still in like this storming phase where like the branding and the major win hasn't happened. So that to me means that we're like 5 years off from it being like a thing, because something needs to emerge that reignites the passion that happened, or the portfolios of the crowdfunded investors just has to continue to increase, where, you know, someone that made an investment when they were 26, now that they're 36, it's worth $1 million, similar to like a home or anything like that. When people have those examples that they can point to for their early investment, then, you know, the ideas would change around it. But at this present moment, I think it's like a feature, not a core component of where venture funding is going to go. But I'm happy that people will have access to funding in that way. In fact, many of some of the a good number of the companies that I've invested in have gone and on and you'll use venture capital. I mean, crowdfunding as well. And I do know that even crowdfunding ain't cheap. So
That's yeah, that's what I mean. The economics of crowdfunding for people don't know when they crowdfund the the startup, right? Some of the cost that comes in, a portion of that gets absorbed by the crowdfunding platform, and the platform is giving up equity. The startup is giving up equity, and usually they get. I mean, there's a there's layers of costs. There's usually some administrative, so they get a portion of a majority, but
yeah,
a portion of that. But that's what it takes, right, to syndicate. That's the administration component, and I think they'll, like you're saying, when there is a big exit and people are made some money with the windfall of crowdfunding, that will be the moments that the sentiment may change. So we'll see
yeah. The
as it
the
unfolds.
wires have to happen. I
Yeah.
think I think that's, I mean, but we're at the stage or at the point, probably, I would say maybe within the next 4 years where, this is the traditional time that early stage investors kind of pay out from when the legislation was enacted to this moment in time. The growth of early stage companies that would need growth, I mean, financing on a crowdfunding platform more than likely should be mature enough where we see some exits, right? And what I hope, my actual hope in the crowdfunding space is that the way that exits usually happen, you sort of have to hopefully have a strong relationship with the founder so that you don't get compressed for whatever reasons. And what I just hope is that because people may have a sincere desire to make sure that crowdfunding works, if they have crowdfunded investors, they protect them at the time of exit. That's my sincere hope.
And share. Can you say a little bit more about that? When they're not protected, what happens? So give some color.
Yes.
What can happen?
What can happen, right? Like, so there's a lot of different interesting, like, so all the times that we're using all these term sheets that we're putting together on the later stages of financing that most of the startups raise, a lot of those things all those terms get like knocked down, and there's whether there's a liquidation preference or things don't convert exactly as you thought they did because it's for so many reasons. What happens is an offer is made to acquire, and then it kind of filters down as to what the capital structure and stack is going to look and who gets paid out from there. And it's not a straight up and down process, right? There is, I don't know how to say it. There's issues in it. Like, there's a lot of choices that can be made, and the protection of minority shareholders is like a hard-earned sort of endowed right that people have because of those moments that when you're a minority shareholder and there's a liquidation or there's a sizable opportunity, a lot of times you get frozen out. And I don't think or foresee that changing, but I do foresee that there will be good actors that will hopefully stand up for their minority shareholders. Because wouldn't you imagine if there was a venture scale exit of north of $250 million, and you have your investors that are maybe have invested $100, right? And then you have someone that just wrote you a check for 100 million. There's life works the way it works, right? So you can there's a reason why there's inequity, and it doesn't stop just because you gave someone money. So
No, I think that is that's some good insight as to who gets paid what when. And I had a professor at in Harvard Business School that used to say, um, the one who has the gold makes the rules. So
exactly.
this is to your AU to your gold analogy and integration. So no, appreciate you sharing that. What's next for Aux21?
So We've been working on a lot of things so that we're prepared and we're ready. So when we actually do our fund close, and we have a couple of things under the hood that are sort of exciting. I think we're ready to share some of them. Some of them are public already. We've been incubating a couple of projects, like one of them you already mentioned, which is Venture the World. It's a sort of publication studio around building the global voice of entrepreneurship. We think that we've been working with a lot of creators and we have our own flagship show. And, so expect more content in that regard around like the voice of global entrepreneurship to be really representative of, entrepreneurs, especially building venture scale opportunities, and then other sort of narrative based shows. And we also are incubating a company called Nomi, which is a beauty technology, basically supporting the sort of influencer economy, the global influencer economy, by being the COO of fashion brands or Insta influencer fashion brands. That's what I would call it. So when someone wants to have it's like a marketplace for um, a lot of things, but manufacturers, designers, and bottlers, and all these sort of things, and piecing it all together so that you almost have a one-stop place, a vertically integrated Shopify. So if you add Shopify layer, then you add it underneath a marketplace like Alibaba, and then you add it underneath a logistics sort of connection platform. That's what Nomi is about. And right now we're piloting with some beauty tech influencers, and we're taking some signups for those pilots for that pilot that we're running. And then I think we have some digital events that we're producing underneath the Venture the World brand. So we've taken on a venture partner. His name is Brian Zisk. And we have another venture partner who's the co-founder of Venmo, Ikram, Magda, and Ishmael. And we are producing some events called Future of Money. Brian is a co-founder and he's the organizer of Future of Money. And we're going to be co-producing the Future of Money this year's 10th anniversary edition, which is virtual. And then we will also be producing sort of some regionally focused panels talking about future of money and venture fintech around the world. So, we're going to be active this fall, very active, and we hope that we can sort of build a community. One of the things that we believe is core to what we intend to invest in are founders that sort of have an ability to build coalitions. That's one of the things that we think is a sort of core tenet that is a make or break founder that can build a global enterprise. Is that someone that can forge coalitions in places that they might find discomfort, especially. And we believe we can see examples of that in people's lives, whether it's from different aspects, whether it's entrepreneurial. Obviously, that's an easy way to demonstrate it because you can build a coalition of investors, build a coalition of employees, and all different sides of stakeholders of your business. That's an easy analog, but we kind of recognize that analog in a lot of other places, whether you're a community organizer or you were a teacher or you were a leader of a union, or you were there's many different ways to demonstrate that same capacity that we recognize. And so that what we also plan to see, we're a venture capital firm, so what you should see or be looking out for some announcements or of investment that we make later in the year, hopefully.
Great. Great. Well, thank you, Chinedu, for sharing your story a little bit more about O21. For everybody watching, this was Chinedu Enekwe on Rebel One Live. So thanks again for joining us, and please tune in for those that are watching. You can hear Chinedu's story on our YouTube channel, and always hear amazing investors and entrepreneurs on Rebel One Live every week. So thanks again, Chinedu.
Thank you, sir, for having me. I appreciate it.